Hi guys, welcome back. Today we're going to talk about something that confuses a lot of people. The difference between exchange traded funds, mutual funds, and index funds. Coming up next, Firefighter Financial Toolbox. Hi guys, welcome back to the show. Hey, a lot of people out there are confused on some things. Today we're going to talk about the difference between a mutual fund, an index fund, and an exchange traded fund. It's really not a big deal. They're all kind of the same thing. They're all three pools of investments that you can make money from in the stock market. So let's break it down. First thing is mutual funds. Now there's two types of mutual funds. You have actively managed mutual funds, which means you have a portfolio manager who tries to pick stocks to beat an index. An index being the S&P 500, for example. This person is paid a good fee to try to pick stocks that he thinks will beat the rest of the normal stocks in the index. Problem is, a lot of times they do not outperform. And of course, the fees that you pay for these funds are going to be higher because we have to pay for this man's or this woman's fees to be the stock picker. Second type of mutual fund is a passive mutual fund or an index fund. The way an index fund is instead of paying someone to try to outdo the market, they buy all the stocks in that index and we get whatever the market gives. So what does that mean? For example, if you have the S&P 500 index fund, they buy all 500 stocks in that market minus a small fee. That's what you get. If S&P 500 goes up 10%, you get 10% minus your small fee. Now, what's an ETF? An ETF is an exchange traded fund. It's a little bit different. They generally follow some kind of an index in that they are a passively managed fund. However, they're bought and sold on the stock market. Now, this is where the thing is quite a bit different. So, an index fund or a mutual fund, when you buy it whatever the NAV price is for the end of the day. So, if I decide, I log on to my account and I say I want to buy $100 of Vanguard Total Stock Market Index, VTSAX. So I can put it in. Now, my transaction isn't going to happen until the end of the day, and I'm going to get whatever the NAV price, NAV being the net asset value of the mutual fund, whatever that price is at the end of the day, that's the price I'm going to pay. Conversely, with an exchange traded fund, it buys and sells on the stock market. So I can go in during the day when the stock market is open and I can see what the price is. And maybe if the price is going down, I decide I want to buy. I can enter an order that I would want to buy at a certain price, and I get it at that price when it gets there. It buys and sells during the day, not just once a day. Now, there's advantages to both. An index fund is a little bit easier in that if I want to, for example, do $50 each month out of my checking account into my Roth IRA that I have. With a mutual fund, I can do that. Every month, $50 will be transferred from my account into my mutual fund, and I'll get the price at the end of the day for that fund. Conversely, with exchange traded funds, because they buy and sell like stocks, you have to buy a share at a time. So for example, let's say that I want to buy VTI, which is the Vanguard Total Stock Market Index, in ETF form. Today, the price is hovering around $147 a share. So I would have to buy $147 for one share of that ETF. I couldn't dollar cost average with $50 a month because I can't buy partial shares. They both have their advantages. For example, if I was just starting out in a new account, let's say I was just opening my Roth for the first time, and I wanted to get the Vanguard Total Stock Market Index, it has a minimum of $3,000 to buy the mutual fund. So I would have to save up $3,000 so that I could buy that fund, and then from there forward I could do $50 a month into it. Where if I wanted to buy the ETF, I could start with one share of VTI, which is the same exact fund, only as an exchange traded fund, and I could buy it for $147 or whatever the price was at that point. Now, both of them have low costs. Costs are very important. The biggest difference that we didn't discuss before on mutual funds is the difference in the ER, or the expense ratio, for each of the funds. Now, every fund has costs. There's no way around that. But because a passively or index managed fund doesn't have to buy and sell stocks on a regular basis, there's less cost because they've already bought the stocks, and it doesn't change what's in it very often. Because anytime a mutual fund buys or sells a stock, if you're holding that in a taxable account, you have to pay for that expense, as well as the fact that we're paying, as I said, for the portfolio manager. So your ER on an actively managed fund may be 1%, as opposed to the Vanguard Total Stock Market Index, which is 0.03%, or about 0.97% less, almost a full percent less. Now, that doesn't sound like a lot of money, but over time, the more money that you have in your account, the more money you have to compound over time, can make a significant difference in how much that ends up being. Now, the question on what's better, an index fund or an ETF? They're the same. It depends on the investor. If you're someone who wants to put a certain amount of money into your retirement savings each month, the index fund is probably the easier avenue for you, because you can put a set amount. Conversely, if you want to be able to say, hey, I see a drop in the stock market today, I want to go buy some of my VTI, some of my total stock market index while it's on sale, then the ETF might be your better option. Remember that you have to buy whole shares, and ETFs have to be bought and sold in a brokerage account. Now, most of your online brokers nowadays have brokerages for your IRAs. So you can get it for your traditional and your Roth IRAs. You can get brokerage IRA accounts. So you're able to buy stocks if you want. You're able to buy ETFs as well. One thing to note on the bid-ask price, you may see this, that your ETF is selling at $147.20, for example, and you think it's going to go down in price, so you put in a bid at $147 even. Now, if that stock goes down 20 cents, it will automatically execute your buy, and you will buy at that price. But what if the price goes up? Now, most of your online brokerages will have a thing where you can say, if you can determine if you want it to be a one-day bid or if you want it to be a 60-day bid. So if you put in your bid and you think it's going to go down today, you could put it in for 1 day, and that, as long as it came down today before the stock market closed, it would execute that buy. And if it did not, then it would cancel the buy. Conversely, if you think that's a good price and you're willing to pay that price to buy some more, you can leave it for up to 60 days. And at any time that it drops below that level, it will go ahead and buy. So those are not all the differences. There are ETFs, as a rule, are index funds, but they also have some that track different things. For example, you could buy, I want all the big stocks in Europe. There's an ETF for almost everything nowadays. But as a rule, most of them follow indexes, and those are the ones that I recommend that you concentrate on. You could get into some weird stuff. Also, remember, my methodology is not to buy and sell stocks or ETFs. If you want to buy it because it's on sale, that's great. But remember, we hold these for the long term, guys. Long-term investing is the best way, especially if you're doing this in a taxable account. Remember, if you buy on sale and then you sell it when you make money, you're going to get taxed on your capital gains on that. And we've talked about that in some other videos, so we're not going to get on that now. But what's better? I have both. In my taxable account, I use ETFs. In my Roth and my wife's rollover IRA, I use mutual funds. They both work good for me, so I stick with them. Anyway, that was a quick overview on mutual funds, index funds, and ETFs. If If you guys have any questions or you have any comments, you think it was a decent understanding, if there's more questions you have about this stuff, leave comments below. If you thought it was a good video, give me a thumbs up, give me a like, and smash the subscribe button, ring that bell, and then you'll get notified every time I make a new video. All right, you guys have a great day. And if you're on the job, stay safe. Thanks.